The stock market is open and the majority of stocks are in the green, other than Alphabet, which is down around 3%, and we have just covered that not too long ago. Now our focus in today is going to be Starbucks, which, as we can see, have replaced their CEO. In fact, he was ousted effective immediately, and the new CEO, the Chipotle one, will be taking over on September the 9th. Now, if you've been following Starbucks, there are no surprises there. Over the last few quarters, they have had some terrible performances, missing analyst targets, which we will come on to. How did the market react yesterday? Well, in fact, Chipotle was down much larger than 6%. It has started to recover, but we can still see not a great performance on that news. And Starbucks had a very strong reaction. They were up around 26%. Now, they have started to come down today, down around 4% after that massive pop after the news of the CEO replacement. And today we want to run through Starbucks. We want to discuss why this company probably isn't a great company right now to buy after the massive pop. Maybe one to consider to sell, but we will do our usual analysis so you can see where we are coming from. Now, first thing that we want to point out, in their latest investor presentation at a very high level, what we can in fact see, their revenue was up only 1% on a year-on-year basis from the same quarter last year. As always on this channel, we want to see it at a minimum 3 to 4% just to keep up in line with inflation. And when we look at the comparatives, we see global revenue negative 3%, US down 2%, and China, as we can see here, in the international sector of 7%, 14 relating to them. Now, when we also take a look at other performances which have been very, very poor, we can in fact see their margins are down 70 basis points to around 16.7. As always, high quality companies, we want to see increases to both revenue as well as margins. Earnings per share also down 6% on a year-on-year basis. And one thing that is very interesting, even with these numbers, they have been expanding those global stores up 6% year-on-year. Now, it's nice to see more Starbucks pop up, but ultimately, if there isn't the footfall of the customers coming in to buy their products, then it doesn't really make a difference. If anything, it is putting more pressure on that bottom line net income as the costs start to rise. And when we take a look at their forward guidance, which is something you should do for every company you have an investment in, what we do in fact see, their top line revenue, they are anticipating low single digit growth. Hopefully we do get to see them increase at least in line with inflation, margins staying flat, and spending around $3 billion on capital expenditures. As we can see, a lot of new store growth anticipated, 12% in China, which is interesting when we just saw that China sales were down double digits. And in terms of their earnings per share, both on a GAAP and non-GAAP basis, flat to low single digits. So not that great, and probably understandable now why we are seeing this CEO being replaced. It has been pretty terrible over the last few quarters, which we will come on to. Now, going back to the company as a whole, yes, it is up around 22% just over the last few days, but year to date, Starbucks is still down around 5%. Over the last year, down around 9%, and over the last 10 years, if you have been a shareholder, you would have marginally outperformed the S&P, up 137%. Bear in mind, this doesn't include dividends reinvested, so it would be up slightly higher. And we do know, in fact, that all-time high, July 2021, we're talking just over 3 years ago, $126. Now, in terms of where this sits right now, it is at the midpoint of the 52-week range. We do get a double buy from Seeking Alpha and Wall Street with a hold from Quant, and we also note the forward yield sits at 2.4% with the forward P of 27, which is significantly higher than the S&P right now at 22.5. So let's dive into this company, the metrics, our valuation, and why we believe this one probably isn't an undervalued buy at this point in time, and potentially you could call it a sell now. First things first, dividend safety score sitting at 60, borderline safe. It was downgraded. It used to be sitting at a safe level, and we can see in September last year, mid to high single digit of 7.5%, which does tell us over the next few weeks, we are anticipating an increase to Starbucks' dividend, which we will be on the lookout for. Now, it was reaffirmed just today that this score stays the same, therefore there is a moderate risk of a dividend cut over a full economic cycle. Now, how did they perform in the last recession? So key metrics, ultimately they didn't pay a dividend, so no comparative data. Negative 6% sales, which is above the average of the S&P at negative 12, and they did trail the S&P negative 69 with the S&P itself negative 55. One thing we do like, but is a bit questionable now, is whether or not they will continue the very nice increases to the dividend. 10% growth over the last 5 years. Love to see that double-digit 17% on average over the last 10. And they have been increasing those dividends for the last 13 years. Now, if you're a regular viewer, you know we look at dividend yield theory, which states a company is undervalued when the current yield sits above the 5-year average. And we do see that for Starbucks, 2.49%. It is higher than the 5-year of 2.09, so still looking undervalued based on this model. We were getting as high as a yield of around 3.1% over the last few weeks. And when we look at the forward P, another undervaluation signal, sitting at 24 versus the 5-year rolling of around 29, but we do note significantly higher than the consumer discretionary of 13.1. Now, as always, we won't look at any of those models in isolation, and we will conclude towards the end when we run through the valuation. First things first then, we want to look at the free cash flow payout below 50% when we're being industry specific for restaurants. We tend to ignore earnings data, which is susceptible to manipulation by management through accounting. And 67% in 2023 doesn't look too bad. 74, a little bit questionable over the next 12 months. So maybe we will start to see a much lower dividend increase in September. Then free cash flow per share, we want to see consistent increases over the longer term. Now, we do get an increase from the negative position in 2014, but understand this is very inconsistent, and over the next 12 months, it is anticipated to come down to around $3.08. Then on the sales growth, we want to see a minimum of 3 to 7%, as we just mentioned, at least to keep up in line with inflation. Not something we did see in their more recent quarter, but overall, when you do zoom out, it does look to be nice. Nearly double-digit growth for the majority of the last 10 years, although we do have that justifiable COVID drop at negative 11%, and 4% on a trailing 12-month basis does give us a truer picture of what we expect to come for the full year. Now, when we look at total sales on a numerical basis, more than doubled over the last 10 years. And one thing we love to see on top of companies that give us those double-digit increases to the dividend is when they return excess cash through their share buybacks. Something we see from Starbucks, very nice overall, but do understand it isn't consistent. And in fact, in 2020 to 21, they did issue some shares, so just bear that in mind. Overall, though, a net share buyback position, which is always great to see. ROIC, one of our most important metrics, 10% or more or 12% for restaurant and industry specific. Give us faith, management are able to effectively allocate their capital. They've done that every single year pretty much, 33% in 2023, which has been increasing from the lows of 9% in 2020. So that is also a good sign, does make it attractive to consider just based off on that metric. And then when we draw your attention to the operating margin, above 16% for restaurants, pretty much straddles around that every single year, so not the worst. Again, do factor in the more recent quarter, their margins have been slipping, and high quality companies will always show us two factors at a minimum: increasing top line revenue, increasing margins. Free cash flow margin, whilst inconsistent, majority of the last 10 years at least hitting that minimum 5% that we do target. Net debt to EBITDA, one of the most important metrics as well, the earnings before the interest, tax, depreciation, amortization. Why we say important? Well, it correlates to both dividend safety and balance sheet strength, and we want to see below 3.5 for restaurants, bearing in mind the numbers you see below are the number of years it would take the company to pay off all of their debt net of cash on hand. 2.06 in 2023, below 3.5 and below the highs of 2020. Expect to be there or thereabouts over the next 12 months. So if you consider this with the fairly high free cash flow payout, you probably could understand why it does sit at the borderline safe score. But ultimately, at the moment, we see no reason why they will be able to continue to offer some nice increases at a bare minimum around the 4 to 5% level. We also want to let you know we have released our latest free weekly article. If you want access to this or any other articles completely free, you can click on the pinned comment below, sign up and start to read straight away. And we have also released our 35 undervalued stocks for August for your consideration, as well as those that are within our portfolio, so do click below and sign up. We also like to take a look at insider and institutional movement, starting off with insiders then, around 2% ownership. However, we do note 2 million of sales over the last year, but what we would say is the more recent one is sitting in quarter 2 around 880k, and then you have to go back to quarter 1 of 376, so you could argue it is a little bit outdated. And for transparency, when we do show you, the more recent one is the 14th of June, the CEO selling around 3,250 shares for $260,000. Now, one, you could argue it is a bit outdated. Two, you could argue the amount is fairly trivial. And three, what we would say here is that insider selling isn't a bearish signal. They sell for many reasons, personal or financial, but information is there if you want to include it in your own investment thesis. Then we get to institutional ownership, 72%, around 7.4 billion worth of sales over the last year, with a little bit more, 8.9 billion worth of buys during the same time period, although we do have to point out in the more recent quarter, institutions have been selling more than they've been buying. So overall, institutions are buying, more recent quarter they are selling, and as we always say, insiders, institutions, any other investor, always do your own due diligence, never copy what they do, that they can ultimately form part of your overall investment thesis. Then we want to get to essentially the income statement. Now we've already discussed their top line revenue, which has looked very nice over the last 10 years. As we can see, more than doubled and fairly consistent if you do take a look at a graphical basis. And when we do draw your attention, it has to be to the bottom line net income to understand what the trends are there, if there's anything similar. Well, look, 2.1 billion in September 2014, 4.1 billion in October 2023, so pretty much doubled their bottom line, not as quickly as their top line, but still moving very rapidly. But we do want to point out a little bit of inconsistency, no surprises in 2020, but overall it is moving in the right direction when you do zoom out over a 10-year period. Then we want to point you to the balance sheet, a quick health check, total cash versus total debt. Around 1.8 billion of cash in short-term investments in 2014, 3.4 billion in the latest quarterly report, so pretty much doubled their cash position. Again, a lot of inconsistency, and nonetheless, this number will never tell you anything in isolation, which is why we look at it both numerically as well as directionally against the total debt, which has gone from around 2 billion in 2014 to around 25 billion in that latest quarter. So massive growth, one of the reasons why we did see that borderline safe dividend score, and in fact it has been increasing over the last 10 years, something just to consider and maybe factor it in when we do look at our margin of safety coming up. Then we get to the earnings. Now we've already discussed, very poor, one of the reasons why the CEO was fired. In fact, the more recent quarter was in line, but the last two were misses, and you have to go back to Q4 of 2023 to see the more recent beat. Now moving forwards, what does that mean? Well, the next quarter they're anticipating a 2% drop year on year, with the next three looking very positive, but again that will be whether or not you can be convinced that they can hit that, given out of the last four they have only beat once, which is a 25% track record. Now if they do hit the September 2025 EPS estimate, the forward P will come down to around 24, which maybe you do believe is more reasonable, or in fact you could argue is still fairly high for this company. Then we want to get to some of the gradings. Now the first one is the valuation. What this means, D-, for example, when we look at the P on a non-GAAP basis, it trades at 27, sector median 15. So if you are buying Starbucks right now, today, you are paying a 77% premium as opposed to others in the sector. Now look, some companies do justify, it is warranted to pay more, but again, we will come to that margin of safety to see whether or not we believe it is sufficient, and this ultimately tells us right across the different valuation methods, Starbucks is a lot more expensive than the sector. Now when we look at the growth, they do get a C-. What we can see here, year-on-year revenue growth 4%, sector as a whole at 2.06, so marginally better. Forward looking, now 6.7%. What we actually saw from their forward guidance, they believe this to be a lot lower, around the low single digit, so that would probably put it right there in line with the sector mean at 3.64. And one of the main reasons why we see that C- today is in effect due to the EPS over the next 3 to 5 years, 9.9% anticipated growth, with the sector here at 10.7. So is it justified when you do look at the growth grades in comparison to the sector that Starbucks trades at a premium? Again, that is completely down to the investor and their thesis. Profitability, well, they get an A+, gross profit margin C- because it's 28% with the sector at 37%. Bottom line margin 11%, as we can see here, the sector at 4.6%. And the main thing that we want to point out there, cash from operations is very significant, 6.5 billion, with the sector median at 265 million. Now look, at a quick recap for this part of the analysis, we still get 2 buy ratings with a hold from Quant, a D- on valuation, a C- on growth, with an A+ on profitability. Now before we get to the valuation, 2 comparisons to do. The first one against others in the sector. We have Chipotle, Mexican Grill, Compass Group, DoorDash, some very big well-known name companies. And look, over the last year, including dividends reinvested, so that is the total return, Starbucks is the worst performing even after the massive jump it had yesterday, -7%. over the last 5 years, what we can in fact see, still one of the worst performing, in fact only doing better than, as we can see, DoorDash at negative 33%. And over the last 10 years, it is there as the third best performing. So when you do zoom out, it hasn't been all that bad. Now remember, past performance is not an indicator of how it'll perform in the future, but it is just something interesting to note. And again, you can add it as part of your wider investment thesis. Now, why we always draw your attention to the S&P comparison, because ultimately where there is no faith in a company or little confidence, you may as well invest in the S&P ETF equivalent. And we can see over the last 5 years, the S&P has outperformed Starbucks. Over the last 10 years, we do see Starbucks outperforming. So again, we'll come down to your confidence. As always though, let us know your thoughts whether or not you believe Starbucks over the longer term can continue to outperform. Now let's jump into the valuation model, and as always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now our intrinsic value of $96, we got this through the 3 different models. The first one being the multiples valuation model. Companies in a similar sector and size, their P multiple, the average multiplied by the EPS of Starbucks to give us our first undervaluation signal. As always though, do remember we're not looking at any one of these models in isolation. We then have the second model, the dividend discount model, with the nice increases over the longer term. Now average at 9.7%, we've gone a lot more conservative at 5.5%, another marginal undervaluation signal here, so that is 2 for 2. And then we get to the DCF model where we have the free cash flow year on year. Growth rate moving forwards at 10% in line with analyst targets over the longer term. With the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we get the first overvaluation signal. So intrinsic value $96, the average of the 3 that you see, and as always you can grab a copy of this model by clicking on the pinned comment below, running in your own numbers, whether it's for Starbucks or any other company on your watch list or portfolio. Now the current price at $92, we always use an MOS on this channel, margin of safety 10%, and we execute on it if it meets our 3 golden criteria. Wide moat, strong financial metrics, good forward-looking data. Now look, if you believe that in today's episode, it is a buy at $86. So right now, you are not getting the minimum 10%. At a 5%, you can see pretty much around that level. So if you're executing on Starbucks, you're getting a 5% margin of safety. And we believe that is way too low. We would want to see a minimum here of around 20%. Because look, at the 15% level, a buy at $82. At 20% around 76, 77, which again you could argue is still leaving a lot to be desired. At the 25% level around $72, which is right there at its 52-week low. Now it will depend whether or not you believe the fact that they have changed their CEO to a very reputable one of CMG is worth paying a bit of a premium for, and whether or not this jump is justified, or in fact, as we have seen today, it could start to continue to come down and cool off. So in today's episode, a 5% MOS with Wall Street indicating a $90 price target. And as we can see here, they see upside of negative 2%. Ultimately, that is downside. Pretty much see it trading around its fair value. As always, let us know your thoughts in the comments below. Is this one that maybe you're looking to sell if you've been buying at the 52-week low? Maybe it's one you're looking to hold, or maybe this isn't something you agree with in today's episode and you still believe it is a strong buy. As always, let us know your thoughts in the comments below. Smash that like button, hit that subscribe and bell button if you enjoyed today's episode. Don't forget to sign up to the free weekly newsletter below, and also sign up to the Patreon if you want to come over and discuss our weekly buys and sells. As always, have a great day and we'll see you all on the next one.